Hey Cosmic family, welcome back to We Are Cosmic, your go-to hub for crypto insights, market analysis, and breaking down the world of digital finance in a way that's easy to understand. If you're new here, make sure to hit that subscribe button and join our community because today we are diving deep into XRP, the token that's been shaking the financial world in 2026. Trust me, what we're about to explore will completely change the way you think about XRP and its future potential. Let's start with a bold statement. Some of the smartest people in blockchain are now saying XRP could one day hit $1,000. Yes, you heard that right. A price that used to sound like science fiction is now being discussed seriously by industry leaders who have years of experience in both traditional finance and blockchain. But how can a coin that's currently trading under $2 even dream of reaching four-digit numbers? That's exactly what we're unpacking today. First, let's get one thing straight. If you're measuring XRP's success by $5, $10, or even $50, you're looking at a world that no longer exists. XRP is no longer just a speculative crypto token. It's becoming the plumbing of the global financial system. Think of it like the pipes that move trillions of dollars silently and efficiently behind the scenes. This isn't hype. This is the production era of blockchain, where real institutional money is starting to flow and the old legacy systems are finally being disrupted. Here's why the math behind XRP is different from anything you've seen before. Unlike other assets, XRP's market capitalization doesn't mean all that money is sitting somewhere waiting to be spent. In reality, market cap is a snapshot. It's a price multiplied by the total supply. And because XRP is designed for flow, even a small inflow of real money can have an outsized effect on the market cap. For example, research shows that in certain conditions, $1 of real capital can push the market cap by $400 or more. This is called the liquidity multiplier effect, and it's a key reason why XRP can reach valuations that seem impossible if you're thinking like a 20th century investor. Now let's talk about the supply side, because this is where things get interesting. Over the past year, XRP balances on exchanges have dropped from 4 billion to 1.5 billion tokens. Why? Institutional investors, through new XRP ETFs, are accumulating and moving large amounts into cold storage, effectively removing these tokens from the public market. When supply decreases and demand remains high or even grows, the price naturally moves upward. This is basic economics, but in XRP's case, the numbers are extreme, making the multiplier effect even stronger. We also have the institutional adoption story. Ripple's technology is no longer theoretical. Banks, payment processors, and treasury departments are integrating XRP as a neutral bridge asset. Instead of pre-funding accounts for days with foreign currency, a system that currently freezes $27 trillion globally, XRP allows instant, real-time settlement. Transactions that used to take 2 to 5 days with SWIFT now happen in 3 to 5 seconds. That's a game changer for global liquidity and capital efficiency. For context, think about moving a massive sum instantly without tying up capital in multiple bank accounts. This isn't just faster, it's structurally transformative. And the numbers back this up. Even with XRP's current low price, the potential to unlock trapped liquidity in the banking system is enormous. Industry leaders like Dom Walk, co-founder of EZA and former Goldman Sachs analyst, argue that $1,000 per XRP isn't a wild guess. It's a logical outcome if institutional adoption continues and the network captures even a small fraction of global cross-border settlement. So here's the takeaway for part one. XRP is no longer just about price speculation. It's about real utility, institutional adoption, and solving a problem that has frozen trillions of dollars for decades. In the next part, we'll dive deeper into the ETF inflows, liquidity multipliers, and how XRP's evolving ecosystem sets the stage for these potentially historic price movements. First, let's talk about the exchange supply drain. Over the past year, XRP tokens on exchanges have decreased dramatically, from 4 billion down to about 1.5 billion. This is not a coincidence. It's a structural shift driven by institutional accumulation through new XRP ETFs. Institutions like Grayscale, Bitwise, and other asset managers are scooping up XRP in bulk and moving them into cold storage, meaning these tokens are no longer available for day-to-day trading. Think of it like water in a reservoir. If the supply of XRP available on exchanges is shrinking while demand continues to grow, or even remains stable, each dollar entering the system has a far greater impact on price. This is called structural scarcity, and it's one of the key reasons why XRP can see price spikes even without massive retail buying. Now, this ties directly into something called the liquidity multiplier effect. Unlike traditional assets, where the market cap roughly equals the cash invested, XRP behaves differently. Because the order books on exchanges are relatively thin compared to institutional demand, a small inflow of capital can move the price across the entire network. Historical examples show that $14.6 million in net inflows once triggered over $1.1 billion in market cap growth, a 78x multiplier. This is not random luck, it's a direct result of XRP being built for flow, not just holding. Every transaction, every token movement affects the network's total value. The more institutions step in, the stronger this multiplier becomes. So even with conservative investment estimates, the math points toward enormous upside potential. Speaking of institutions, let's focus on the ETF inflows themselves. Since the late 2025 launch of spot XRP ETFs, we've seen 40+ consecutive days of positive inflows. Unlike retail traders who often flip positions quickly, institutional money is sticky. These funds are being held in cold wallets for years, not days. This creates a unique environment. The market is being structurally supported from the top down rather than being driven by speculative hype. A visual way to understand this is imagining the market as a scale. On one side, you have retail traders, retail hype, and short-term momentum. On the other side, institutional capital, ETFs, and locked up XRP. Right now, the institutional side is outweighing the retail side by a massive margin. This structural bid is silently driving the market higher without dramatic daily headlines. Another point, this isn't just about accumulation, it's also about reducing available float. As XRP is removed from exchanges, there's less supply for retail traders to sell into, creating scarcity. Scarcity plus demand equals upward price pressure, and when combined with the liquidity multiplier, it amplifies every dollar of inflow exponentially. Now consider the real-world implications. If XRP captures just a fraction of global cross-border settlements, trillions of dollars per day, the velocity of money alone supports a high valuation. This isn't hypothetical. Banks and corporates are starting to use XRP as a neutral bridge asset, reducing pre-funded accounts and unlocking capital that was previously trapped. Every dollar moved on the XRP ledger is performing hundreds of times more work than the same dollar in the legacy system. Lastly, let's connect this to the $1,000 thesis. Even though it sounds astronomical, the combination of shrinking exchange supply, institutional ETF inflows, and liquidity multiplier effects makes it plausible. The key takeaway is this: XRP's price is no longer dictated by retail sentiment or speculation. It is increasingly being set by real utility, structural demand, and institutional positioning. Cosmic family, here's your action point. Watch the ETF inflows, monitor exchange supply, and understand how liquidity multipliers amplify every move. This knowledge is power. It allows you to see beyond daily price noise and understand why XRP might be heading toward unprecedented valuations. For decades, international finance has relied on a pre-funded model. Here's how it works. When banks send money abroad, the funds don't actually move instantly. Instead, banks must maintain massive piles of cash in foreign accounts, called nostro and vostro accounts. This ensures payments can clear, but it's incredibly inefficient. Right now, estimates suggest there's $27 trillion sitting idle worldwide just to make the system function. That's trillions of dollars frozen in accounts instead of being used for lending, investments, or economic growth. Now imagine the opportunity. XRP and the XRP ledger offer a way to bypass this slow pre-funded process. By using XRP as a neutral bridge asset, banks and corporates can move value instantly without needing to park huge sums in foreign accounts. What used to take 2 to 5 days can now happen in 3 to 5 seconds. This is more than just speed. It's a revolution in capital efficiency. The same amount of money can perform hundreds of times more work in a day compared to the legacy system. Ripple's team recognized this problem back in 2012. Their goal was not to create a token for speculation, but to unlock trapped liquidity. With XRP, the system doesn't need pre-funding. Transactions settle instantly, and the same capital can be recycled multiple times in a single day. In other words, every dollar flowing through XRP can have an outsized impact on global finance, creating both utility and upward price pressure. Fast forward to January 2026, this vision is becoming reality. Ripple's infrastructure is now part of institutional treasury operations. Payment processors, banks, and corporates are integrating XRP into daily workflows. Ripple's president, Monica Long, calls this the production era. It's no longer about debating blockchain technology. It's about actually moving trillions of dollars on the ledger. To visualize this, think about the current banking system as a river blocked by dams. Money sits stagnant in accounts, unable to flow efficiently. XRP acts like a new set of channels, letting this river move freely. As these institutional channels open, the trapped 27 trillion is no longer idle. It begins to unlock, circulate, and create economic activity. And as this happens, the need for XRP naturally increases because it serves as the fuel moving this capital in real time. This structural shift also explains why the market behaves differently than you might expect. Traditional finance looks at market cap and assumes it represents physical money in the system. That's not accurate. XRP's market cap is a reflection of price multiplied by supply, and because institutions are using XRP to move real capital efficiently, even small inflows can drive disproportionately large market cap increases. Moreover, as more capital flows through XRP, exchange supply continues to drop. Combined with sticky institutional holdings, this creates a scenario where scarcity and demand reinforce each other. Each dollar of capital now moves more efficiently than ever, accelerating XRP's potential growth and valuation. Another important factor, XRP's integration with banks doesn't require them to overhaul their existing infrastructure. Partnerships with companies like DXC Technology allow Ripple to embed its payment rails directly into existing banking systems. This means XRP can operate seamlessly within $5 trillion in assets without forcing institutions to take on additional risk or disruption. The big picture? XRP is no longer just a speculative coin. It's becoming the plumbing of global finance, solving a problem that has frozen trillions in idle capital for decades. The stage is set for price growth not because of hype, but because of real structural demand and utility. Let's start with speed. Traditionally, sending money across borders through banks takes 2 to 5 days using the SWIFT network. Funds are often tied up in multiple accounts, subject to pre-funding requirements, and delayed by bureaucracy. XRP, on the other hand, settles transactions in 3 to 5 seconds. That's not just a small improvement, it's thousands of times faster. Imagine being able to transfer millions across continents in seconds instead of days. This kind of velocity unlocks enormous efficiency for corporates, banks, and financial institutions, making the network not just faster, but far more powerful than legacy systems. This speed is part of why XRP is becoming the preferred bridge asset for institutions. Banks don't have to overhaul their existing systems. With partnerships like DXC Technology, Ripple integrates directly into banking infrastructure, including platforms managing trillions in deposits and hundreds of millions of accounts. This allows financial institutions to move digital assets as easily as traditional deposits while maintaining regulatory compliance. Essentially, XRP acts as a low-cost, neutral fuel for moving wealth globally. Here's where the magic happens. With XRP's ledger, the same dollar can flow multiple times a day, creating an exponential effect on market utility. Think about it. Capital that was once frozen in Nostro accounts can now be recycled instantly. Every transaction increases the effective usage of XRP, which increases demand and, by extension, the potential valuation of the token. This is exactly what analysts like Dom Walk and Ripple executives are highlighting when they discuss the $1,000 thesis. Institutional adoption is also reshaping the market structure. The introduction of XRP spot ETFs in late 2025 has funneled billions into XRP, and unlike retail money, this capital is sticky. Institutions are holding tokens in cold storage, removing them from active trading. This shrinkage in available supply, combined with rising demand, creates scarcity that naturally pushes prices higher. The math here is simple. Fewer tokens on exchanges mean that every additional dollar flowing in has a bigger impact. To visualize this, think of XRP as a bridge spanning a river of frozen capital. On one side, trillions of dollars sit idle in banks. On the other side, Ripple's ledger provides a high-speed, low-cost route to move that wealth. As more institutions use this bridge, XRP becomes essential infrastructure, not just a speculative asset. Its value rises because it's the only tool capable of handling these massive flows efficiently. Another point to consider is the liquidity multiplier effect, which we touched on earlier. Every dollar entering the XRP network doesn't just incrementally increase its market cap, it can amplify the network's value hundreds of times over. This happens because as liquidity is thin on exchanges and most tokens are held by institutions, even small inflows dramatically influence the price of all tokens. Put simply, XRP is built to do more with less, which makes it a perfect tool for large-scale financial operations. And the story doesn't stop with traditional banking. XRP's ledger is now bridging into the decentralized finance ecosystem through initiatives like the XLS38 EVM sidechain. This integration allows developers to build DeFi applications on XRP's fast, low-cost network. In other words, XRP is not just a bridge for banks. It's also becoming the backbone for a growing DeFi ecosystem, increasing token velocity and demand from multiple fronts simultaneously. The takeaway for Part 4 is clear. XRP's speed, institutional integration, and role as a bridge for trapped liquidity are not theoretical. They're happening right now. This is what separates XRP from other cryptos still relying on hype or speculation. The token is becoming a structural asset for global finance capable of moving trillions efficiently, safely, and quickly. Cosmic Family, in the next part, will explore the XLS38 EVM sidechain, DeFi migration, and how new XRPFI applications are creating exponential demand, which is another crucial piece of the $1,000 thesis puzzle. This is where XRP's utility as both institutional and retail infrastructure becomes truly unstoppable. So far, we've covered XRP's market structure, ETF inflows, liquidity multipliers, and its role as a bridge for $27 trillion in trapped capital. Now we're stepping into a new frontier, how XRP is expanding beyond banking and becoming a foundation for decentralized finance, DeFi. This is the part that changes the game entirely. In early 2026, Ripple fully deployed the XLS38 EVM sidechain, which allows developers to run Ethereum-compatible smart contracts directly on the XRP ledger. This is huge. For over a decade, XRP was known primarily as a fast and cheap payment token. Critics often called it a one-trick pony, limited to cross-border transfers. The XLS38 sidechain changes everything by combining XRP's speed and low fees with Ethereum's massive developer ecosystem. The result? A surge in XRPFI applications. We're talking decentralized lending platforms, automated market makers, and complex DeFi protocols, all running efficiently on XRP. Developers who once avoided XRP due to limited smart contract functionality are now migrating to this ledger, attracted by low transaction costs and instant settlement times. This migration isn't small, it has the potential to dramatically increase XRP's utility and token velocity. More utility means more demand, which supports higher valuations. Additionally, XRP's XLS30AMM protocol provides deep on-chain liquidity, ensuring these DeFi applications can operate smoothly. With the EVM sidechain layered on top, the network now supports both institutional flows and retail DeFi activity simultaneously. Think of it as a dual-engine system. One engine serves banks and corporates, and the other fuels retail developers and users. This combination is rare in crypto and sets XRP apart from networks that focus solely on one type of participant. Another key point, this integration is critical for the $1,000 thesis. When XRP is used not only as a banking bridge, but also as the primary collateral for global DeFi, the token's velocity increases exponentially. Every transaction, loan, or smart contract execution requires XRP to move and settle value. This is what we call multi-dimensional utility. The token is no longer a single-use asset, but a core component of multiple financial systems. To put it simply, the supply-demand math is stacking up. Exchange supply remains low due to institutional accumulation, ETFs continue to lock away tokens, and now the DeFi ecosystem is adding new layers of consistent demand. Combine these factors with the liquidity multiplier effect, and you begin to see why valuations previously thought impossible are actually achievable. It's also worth noting that this expansion strengthens XRP's network effect. The more developers build on the ledger, the more users and institutions interact with it, creating a self-reinforcing cycle. Each new DeFi application increases the token's utility, which attracts more capital and usage, further reducing available supply. This virtuous cycle is precisely what can turn structural demand into a long-term price floor, a critical element for anyone betting on the $1,000 thesis. Furthermore, the integration with the XLS38 EVM sidechain positions XRP as a competitor to Ethereum and other smart contract platforms. but with a unique advantage: instant settlement and low transaction costs at scale. Instead of just being a secondary network for small transactions, XRP is now a platform capable of handling institutional scale DeFi and payments concurrently. Cosmic family, here's the key takeaway from Part 5. XRP's future isn't just about institutional banking adoption. It's about building an entire financial ecosystem. By bridging traditional finance and DeFi, Ripple has created a network that attracts capital from multiple sources simultaneously. This is why the narrative around XRP is shifting. It's no longer speculation, it's structural utility, and understanding this is crucial for anyone serious about crypto markets. We've taken a deep dive into XRP's structure, ETF inflows, liquidity multipliers, institutional adoption, and DeFi expansion. Now, in this final part, it's time to look at the real-world risks and challenges that could affect XRP's trajectory, and why understanding these factors is just as important as understanding its growth potential. First, let's talk about regulatory hurdles. The US is still grappling with digital asset legislation, and XRP has been in the spotlight for years due to ongoing litigation and policy uncertainty. While XRP is gaining institutional traction, regulatory delays like the Digital Asset Market Clarity Act stalling in January 2026 show that even high-potential projects can face legal roadblocks. These delays can temporarily slow adoption or create price volatility, which is why investors need to stay informed. It's important to recognize that these regulatory challenges aren't necessarily permanent barriers. They're more like speed bumps on XRP's path. Once the legislation clarifies how digital assets like XRP are treated, it could actually accelerate institutional adoption. Until then, understanding the political and macroeconomic calendar is critical. Events like government shutdowns, tariff disputes, or central bank policies can influence short-term market behavior, even for assets with strong structural utility. Next, let's address technical market risks. XRP's price is influenced by both supply constraints and institutional accumulation. While these factors create scarcity, they also mean that XRP is sensitive to short-term liquidity shocks. For example, a single ETF outflow or macroeconomic panic could trigger temporary drops in price. Investors should understand that the path to high valuations, including the $1,000 target, isn't linear. It will likely include periodic corrections. Now, let's talk about market mechanics and the path to $1,000. The math isn't as crazy as it seems. Even at a $1,000 price, the total market cap doesn't require the entire world's GDP to sit in XRP. Why? Because of the liquidity multiplier effect and the high velocity of money on the XRP ledger. As trillions of dollars move through banks and DeFi applications using XRP as the bridge or collateral, the network handles many times the nominal capital in real transactions. Every dollar flowing efficiently can have an outsized impact on market cap, meaning that high prices can be structurally supported without needing literal deposits. Another factor is sticky institutional money. Spot ETFs, cold storage, and corporate allocations mean that a large portion of XRP is effectively locked away from daily trading. This creates a persistent supply shortage that amplifies price moves when demand surges. Combine this with growing DeFi adoption on the XLS38 EVM sidechain, and XRP is positioned to see both institutional and retail-driven demand converge. However, it's crucial to maintain perspective. Macro factors, including interest rates, economic downturns, and geopolitical instability, can still impact XRP's performance. A strong thesis like the $1,000 target assumes continued adoption, smooth regulatory progress, and institutional confidence. Any significant deviation from these assumptions could delay the timeline or affect interim valuations. Finally, here's the big picture takeaway. XRP is no longer just a speculative crypto, it's becoming core financial infrastructure. The combination of institutional adoption, exchange supply scarcity, liquidity multipliers, DeFi utility, and fast transaction settlement creates a network that supports high structural value. While risks exist, the fundamentals show a clear pathway for long-term growth. Cosmic family, to summarize our 6-part deep dive, XRP is solving a $1 trillion liquidity problem in legacy banking. Institutional adoption through ETFs and cold storage is creating scarcity and structural demand. The liquidity multiplier effect amplifies even small inflows, increasing market cap disproportionately. XRP's speed and efficiency make it essential infrastructure for global payments. The EVM sidechain and DeFi migration add multi-dimensional utility and token velocity. Regulatory hurdles and macro risks exist but are navigable with careful analysis. By understanding all these layers, you're not just following a token price. You're following the construction of the financial network of the future. And that's why the $1,000 XRP thesis isn't just hype. It's a calculated projection based on structural utility, demand, and innovation. Cosmic Family, drop your thoughts in the comments. Do you see XRP reaching 4 digits, or do you think regulatory and market risks will slow it down? Let's discuss. And if you want real-time alerts, whale moves, and advanced technical insights, check out our Discord or membership programs. Links are in the description.